Hello and welcome back to another installment of Daily Day Trades YouTube. Today we're going to be going over how to average down correctly because I see so many people mess this up. We're going to talk about the different mindsets to have when averaging down, when to do it, when not to, and the difference between dollar cost averaging and just changing a cost basis on a trade. So right now we are in an averaging down pandemic. Everyone had this mindset of, oh, you can't lose money if you don't sell. That is absolutely 100% not true. I'll give you an example. So if you bought into all of these hype stocks back when they were going crazy and now you're stuck in that position, you're not necessarily losing the money, you're not realizing the loss, but as you hold that forever and ever, the money that's in there could be in other positions that are making money and going up. And if it's something like AMC or GameStop, then you're probably not going to see it ever hit those prices again. So you're not only suffering from an opportunity cost, you're also going to suffer just directly financially once you do decide to sell it. First up, we're going to talk about how to average trades correctly. And by trades, I just mean something that you're not looking to invest in long term. Now, for the sake of the example, let's just say that we bought it somewhere around here. Obviously, it continues to go up, everything is good, we're happy, and then we eventually hit a break-even point. Preferably, we would have taken some profits in this range because we're up almost 100% at this point. By doing that, we can make some of these shares risk-free, but let's just assume that you did not sell anything when you get to this break-even point, and then we drop below the point where we bought it at. So what happens here? Preferably, you would have a stop loss and you'd just be kicking yourself that you didn't take profits at the top here and you wouldn't get stuck in all of this crap going down here. Let's say there was no stop loss though, so we are riding this out all the way until the end. Most of what I see is people would be buying it here or here, just somewhere on the way down, even though it's basically dropping directly into the ground. When you're looking at those places, you have to think to yourself like it's a completely separate position. So if you were just now opening a trade on MARA, would you buy it at that point? So let's look at this. Would you buy it here? No, probably not. It just tanked and now it's consolidating. It's going to pick a direction at some point, and look at that. It goes straight down. Not good. Would you buy here where there's a little bit of hope and it kind of looks like it might come back? It's bouncing off some previous support here. Absolutely not. I mean, look at this. It's the most aggressive downtrend of all time. So if you were looking at this just as a normal trade, you didn't already have some of this that you're holding, and you see this right here after this aggressive drop down. Let's just ignore the ticker, ignore Bitcoin, ignore everything. If you really looked at this and just one little jump up at the tip of this trend, would you look at that and say, that's a really great place to buy this? And I hope the answer is no, unless you are investing. In this case, we're talking about trades. So if we're trading off trends and the patterns that we know, charting, whatever it is, chances are this is not going to meet any of your criteria to buy. But that is where I see most people buy to average down. So when do you average down? This would be a reasonable example of when to average down. We have Shopify basically going straight down here, and then this clear consolidation here at the bottom. It's bottomed out here multiple times. It tried to break through it and still didn't go much lower, went back up, still trading in this range for the most part. But once it breaks out here, that's not a terrible place to buy it. Sure, there's always the risk it could go straight down like this, but when you're averaging down, you have to be thinking about getting out of the trade under pretty much any circumstances. The goal getting out of a trade might be to break even, or it might be to just lose 5% when you're already down 50. Get back to something reasonable. In order to do that faster, you can average down with significantly more than you initially bought in with. And if you didn't average down during stupid times like we showed in the last example, then you should have a cash balance that can facilitate you averaging down with a significant amount of money. That would look something like we buy it here because we got a false positive. We thought it was going to skyrocket again for some reason. Bad trade, didn't have a stop loss, probably should have sold out there, but it keeps going down and now we're freaking stuck. We initially bought in with 10 shares, let's say, and then here when we think it's going to go back up, we can just buy in with 30. And then we actually have to stick to our stop loss too. So if it doesn't work, get rid of it. You already are raising your risk by averaging down. If it doesn't work out, just dump it. I picked this one on purpose because it didn't work, and it's more important to not get stuck with even more money than it is to, be successful in these sometimes. Something like this would work for sure. You buy in here, obviously it tanks, and now you're stuck in a trade again. After this little run up here, you don't buy it, not quite enough, but it breaks past that level and you're like, okay, I'll get some. If you buy in here with, let's say 3 times or 2 times what you bought into this with, then you really only have to get a little bit of a jump. If right here you're buying 2 times what you initially bought in with, then you don't need it to get back to this initial price. It only has to get up halfway through this range to break even. So if we're following this example, then that's only a couple weeks and you're out of there after months and months of stressfulness. One thing that you really need to do before you start averaging down on something is to try and see the difference between a better value and a warning sign when the price drops. Now, I keep mentioning that this only applies to trading, and that is true because there is something called dollar cost averaging. This will be something you probably do when you're starting a long-term investment or something, and you're going to have, a set time that you're going to invest into a stock no matter what. That could be once a week, once a month, once a quarter. It is literally just averaging, not up, not down. You're just buying it at a set time no matter what the price is. This allows you to have a roughly median price over a set time frame to begin your investment. When you're dollar cost averaging, you might see the stock going straight down as a good thing. So that's where it completely differs from trading. In trading, we want to be with the trend. In dollar cost averaging, we're just excited to get it at a lower price. In the description of this video, there is a link that will take you to my website. This is where I post all sorts of stuff regarding education or answering questions, whatever it may be. It's usually posted on here or the Discord. Speaking of, there is a button here to sign up for the trade alerts, where I post all of the trades that I make every single day. And right now you can try out the alerts for free for 30 days. If this video was useful to you, hit the like button, please, so other people will see it as well. These take well over an hour to make, and clicking a button really only takes a couple seconds. Much appreciated. I will talk to y'all tomorrow.